We're back. Okay. New one. Okay, last episode. Let's make a new stream notes. So we saw last episode a stock split happens when a company increases the number of its shares to boost the stock's liquidity. Right? Equity, a degree of residual ownership in a firm or asset after subtracting all debts associated with that asset. Okay. Outstanding shares refer to a company's stock currently held by all its shareholders, including share blocks held by institutional investors and restricted shares owned by the company's officers and insiders. Okay. Fixed income security is an investment that provides a return through fixed periodic interest payments and the eventual return of principal at maturity. Example includes treasury notes, treasury bond, treasury bills, municipal bond. A bond is a fixed income instrument, also known as a debt security, that represents a loan made by an investor to a borrower, typically corporate or governmental. A bond could be thought of as an IOU between the lender and borrower that includes the detail of the loan and its payments. Bond is a fixed income instrument, also known as a debt security. Okay. An asset-backed security is a type of financial investment that's collateralized by an underlying pool of assets, usually ones that generate a cash flow from debt, such as loans, leases, credit card balances, or receivable. It takes the form of a bond or note. Okay. A limited liability company is a business structure in the U.S. that protects its owners from personal responsibility for its debts and or liabilities. Limited liability companies are hybrid entities that combine the characteristics of a corporation with those of a partnership or sole proprietorship. While a limited liability features similar to that of a corporation, the availability of flow through taxation to the members of an LLC is a feature of a partnership rather than an LLC. Angel investor provides initial seed money for startup businesses, usually in exchange for ownership equity in the company. Angel investors aren't usually in the loan business. They're putting money into an idea they like. Okay, tracking errors, the divergence between price behavior portfolio and the price behavior benchmark. Gotcha. Okay, so let's see what tabs we can close. So yeah, we're down to these tabs now. Hold on, let me check something real quick. What the fuck? Hold up. Okay, tracking error. Right, this is what we read. The divergence between the price and behavior is reported as a standard deviation. percentage difference, which reports the difference between the return of an investor receives it. They were attempting to imitate. Tracking error is a difference in actual firms between a position. Of how actively a fund is managed and is corresponding. Evaluating a past tracking error of a portfolio manager may provide insight into the level of benchmark risk control the manager may demonstrate in the future. Gotcha. I think I can just watch the video, and we could end with this tab. Doesn't seem too necessary. Hopefully we can do Roth IRAs today. Hoping. Okay.
Tracking error is the difference between the return on a portfolio or fund and the benchmark it is expected to mirror or track. There are two ways to calculate the tracking error. The first is the easiest. Simply subtract the fund's return from the return of the index it is supposed to track. For instance, a mutual fund that is pegged to the S&P 500 had a 7% return for the year, whereas the S&P had an 8% return. The tracking error is 1%. The second way to calculate the tracking error is more complicated but more informative. This calculation involves taking the standard deviation of the difference in the fund's and index's returns over time. The formula is where n is equal to the number of periods, x equals the fund's return for each given period, and y equals the benchmark's return for each period. A low standard deviation means the fund tracks the benchmark fairly closely. A higher standard deviation means the fund does not track its benchmark very well. These figures indicate how well a fund is managed. Investors seeking a fund that accurately tracks their preferred index should look for funds with low tracking errors.
Okay, I think we're good with tracking errors. Makes sense. How to evaluate your 401k options. Let's look at ETFs or ETFs will track a particular index sector, commodity, or other assets, but unlike mutual funds, ETFs can be purchased or sold on a stock exchange the same way that a regular stock can. Okay. Let me just make sure I never wrote about this. I mean, I guess I... Okay. An ETF is called an exchange traded fund because it's traded on an exchange just like stocks are. The price of an ETF shares will change throughout the trading day as the shares are bought and sold on the market. This is unlike mutual funds, which are not traded on exchange and which trade only once per day after the markets close. Additionally, ETFs tend to be more cost effective and more liquid compared to mutual funds. Okay.
An exchange traded fund, or ETF, is a basket of securities that trade on an exchange, just like a stock does. An ETF is a marketable security, meaning it has an associated price that allows it to be easily bought and sold. ETFs can contain many types of investments, including stocks, commodities, bonds, or a mixture of investment types. There are various types of ETFs available to investors. Let's explore some popular options on the market today. Stock ETFs comprise a selection of stocks to track a single industry or sector. For example, a stock ETF might track automotive or foreign stocks. Bond ETFs invest in various fixed income securities, like corporate bonds or treasuries. Unlike bonds themselves, bond ETFs don't have a maturity date. Industry or sector ETFs are funds that focus on a specific sector or industry. For instance, an energy sector ETF will include companies operating in that sector, like natural gas, oil, and renewable energy companies. Commodity ETFs invest in commodities, including crude oil or gold. And holding shares in a commodity ETF is cheaper than physical possession of that commodity. Currency ETFs track the relative value of a currency or a basket of currencies, including foreign currencies. There's even an ETF option for Bitcoin. Inverse ETFs attempt to earn gains from stock declines by shorting stocks. Essentially, inverse ETFs are bets that the market will decline. When the market declines, an inverse ETF increases by a proportionate amount. While there are many types to choose from, all ETFs offer similar benefits: access to a wide variety of stocks, lower expense ratios, fewer broker commissions, and risk that is managed through a diverse portfolio.
Okay. Um, thousands of stocks across various industries, or it could be isolated to one particular industry or sector. Some funds focus on only U.S. offerings, while others have a global outlook. For example, banking-focused ETFs would contain stocks of various banks across the industry. ETF is a marketable security, meaning that it has a share price that allows it to be easily bought and sold. Oh wow, they blew up. pros of ETFs are access to many stocks across various industries, low expense ratios and fewer broker commissions, risk management through diversification. ETFs exist that focus on targeted industries. Actively managed ETFs have higher fees. Single industry focused ETFs limit diversification. Lack of liquidity hinders transactions. Okay. Okay. I get it. Okay. I think that's enough. A mutual fund is a financial vehicle that pools assets from shareholders to invest in securities like stocks, bonds, money market instruments, and other assets. Mutual funds are operated by professional money managers who allocate the fund's assets and attempt to produce capital gains or income for the fund's investors. A mutual fund's portfolio is structured and maintained to match the investment objectives stated in its prospectus. By professional. Oh yeah, I want to see this. It'll be worth 8,000. It's more reasonable. Well, no, 2018 is not that crazy for Tesla. Everything's up, but who is this? Is this a ad? No, that's just the best video. I mean, yeah. Mutual funds give smaller individual investors access to professionally managed portfolios of equities, bonds, and other securities. Each shareholder therefore participates proportionally in the gains or losses of the fund. Mutual funds invest in a vast number of securities, and performance is usually tracked as this change in the total market cap of the fund derived by the aggregating performance of the underlying investments. Most mutual funds are part of a larger investment companies such as Fidelity Investments, Vanguard, T. Rowe Price, and Oppenheimer. Oppenheimer's an investment company. A mutual fund has a fund manager, sometimes called as investment, who's legally. it deleted this one. Um, I mean, feel like I still don't understand mutual funds. Pros of mutual fund. What is this? We're definitely watching that.
Are exchange-traded funds riskier than mutual funds? The answer? It depends. Both ETFs and mutual funds invest in a portfolio of assets determined by the portfolio or investment manager. Those assets can include securities like stocks, bonds, or commodities. They vary widely in size, diversification, and objective. Some aim for long-term steady returns with broad market exposure, while some seek short-term volatile investments that offer high potential returns. One main difference is that ETFs trade on an exchange and are bought and sold like stocks based on the price investors are willing to pay at a particular time. Mutual funds can only be purchased for a price that is calculated once per day, at the end of the day, based on their net asset value. ETF investors who want to quickly place a trade can do so immediately, if it's during trading hours. For mutual funds, investors have to wait until the NAV is calculated at the end of the day to see if the fund's price has changed. But for both types of investments, the risk any ETF or mutual fund carries depends on the underlying portfolio holdings and its performance targets. For example, the most common ETF strategy is to track an underlying index, such as the S&P 500. These funds invest in the same stocks that are on the index, so their risk profiles are subject to the performance of the S&P 500 companies and anything that might impact them or the markets as a whole. Mutual funds can also track an index, but in both cases, an ETF or a mutual fund invested in fixed income assets like bonds will have less risk due to the inherent stability of those securities. Funds that invest in specific narrow markets like energy will carry more risk, along with the potential for higher returns. So, the short answer is no. ETFs are not automatically riskier than mutual funds. It depends on the type of fund, its portfolio holdings, and the broader market environment.
Is S&P 500 a mutual fund or ETF? Okay, it's literally the same thing. Okay, so now I'm chilling. I have notes about it though. Right. Oh, I have the who's to blame for the subprime. Ooh, this is an interesting article. Wait, let me search this again. Okay. Okay, I'm good with the next ones. Whew, tearing through these tabs. What are financial securities? The term security refers to a fungible. I definitely have security written down. Yeah, I do. Okay, so I'll just review this. Is a type, it refers to fungible. Ah, okay, so fungibility means like I can exchange this quarter for your quarter, but I can't for NFTs. I can't exchange my Bored Ape for your Bored Ape. They're different. They're fundamentally different. Inherently different by the nature of the
Send them back with a new
signature left on
15-inch
the
MacBook Air
blockchain.
that does it all, and keep it protected with a My Best Buy Total
The
membership.
appearance of the Bored Ape is irrelevant, just like it's irrelevant for a quarter to have the state of California versus a quarter to have the state of New York, barring any like rarity fucking collector stuff. But between those two things, they still hold the same value. You can easily exchange them for the exact same thing because they're both fungible.
Fungibility refers to a good's or asset's interchangeability with another good or asset. Fungible assets simplify the exchange process because they're assumed to possess the same value. Gold is fungible because 1 ounce of gold equals another ounce of gold. A gallon of gas is fungible because all gallons of gas are the same. But a pair of pants is not fungible. Not all are the same. Each brand and style has a unique value, and you wouldn't want to wear someone else's pants. In addition to certain commodities, fungible financial instruments include cash, since one US dollar is the same as another US dollar. Stocks, options, and futures contracts for the same company are also fungible. Whether you buy shares of XYZ Corporation in its home country or on a foreign exchange, they're still shares of XYZ stock.
I can exchange my quarter for another quarter because they have the same value, even though they may appear differently. Mine, the state of New York. There's the state of Wyoming. I cannot do the same with an NFT. Example, Bored Ape. What is it? Bored Ape? Since they are inherently non-fungible. Signature left on the blockchain, not the appearance of the ape. Okay. It's good. Securities are fungible and tradable assets used to raise capital in public and private markets. There are primarily 3 types of securities: equity, which provides ownership rights to holders; debt, essentially loans repaid with periodic payments; and hybrids, which combine aspects of debt and equity. Public sales of securities are regulated by the SEC. FINRA.
Not sure on the pterodactyls, but drops and spills are covered.
Send them back with a new 15-inch MacBook Air that does it all, and keep it protected with a My Best Buy Total membership.
We're going to start off easy with things that most of us are pretty familiar with. So we're going to start with the idea of what is a security. Most of us are familiar with the term, but the technical definition of a security is that it's paper traded for value, where a profit's anticipated through third-party management. Now, the 2 basic types that most of us know are going to be stock and bonds. Equity, or stock, is going to give a customer ownership in the security, whereas bonds or debt securities are going to give the customer loanership positions. We have other types of securities as well besides stocks and bonds. We also have mutual funds, variable annuities, which are considered to be securities, options, which are securities in their own right and derive their value from the underlying security, and we also have rights and we have warrants. Now, it's really important for the test to determine what's a security and what's not. So things that are not considered securities, if you see whole life insurance policies, those are not securities. If you see term life insurance policies, those are not securities. Fixed annuities are not securities. Now remember, variable annuities are, so you want to be able to make that distinction for the exam. IRAs and retirement plans in and of themselves are also not securities. They're actually shoe boxes, if you will, and you put your securities into the shoe boxes, which would be an IRA or some other type of retirement plan. A prospectus is not a security because a prospectus is nothing more than a disclosure document. And a confirmation is not a security because your confirmation actually confirms that whatever trade you wanted executed was in fact executed properly. So again, for the exam, one of the questions you can see is what's a security and what's not a security. When a corporation decides that they are going to incorporate, the first thing that they do is they go out and they hire themselves a lawyer. Now that lawyer is going to draw up their corporate charter. And in that corporate charter, they're going to address the idea of common stock. Now that common stock that they address will be in the form of authorized common shares. So the easiest way to think of it is that authorized common stock is stock that has been authorized for sale in the corporate charter. Now the registrar is an entity that's put in place or hired by the issuer to make sure that the corporation does not issue more shares than they've authorized in their corporate charter.
She's complicating it to a hard degree, very high degree. Okay, I don't think we got to go this deep into the securities yet, because I just want to be able to understand Roth IRAs. So we're gonna have to. Yeah, this makes sense. Passive. Yeah, that's common sense, dude. A call option is a financial derivative that gives its owner the right to buy a specified security at a price within a certain period of time. Right. I don't even understand how call options can come into I don't even think okay, I don't think I gotta worry about call options yet, bro. Okay, that leaves me with the subprime crisis. Alright, let's do this. I'm reading the whole page. This is interesting. Anytime something bad happens, it doesn't take long before people start to assign blame. It could be as simple as a bad trade or an investment that no one thought would bomb. Some companies have banked on a product they launched that just never took off, putting a huge dent in their bottom lines. But some events have such a devastating effect that they end up having an effect on the overall economy. That's what happened with the subprime mortgage market, which led to the Great Recession. But who do you blame? When it comes to the subprime mortgage crisis, there was no single entity or individual at whom we could point the finger. Instead, this mess was the collective creation of the world's central banks, homeowners, lenders, credit rating agencies, underwriters, and investors. Read on to find out more about each individual player. The subprime mortgage crisis was the collective creation of the world's central banks. Yep. Lenders were the biggest culprits, freely granting loans to people who couldn't afford them because of free-flowing capital following the dot-com bubble. Gotcha. Borrowers who never imagined they could own a home were taking on loans they never knew they may never be able to afford. Investment banks, rating agencies, and hedge funds also had a role to play in the subprime mess. Investors hungry for big returns bought mortgage-backed securities at ridiculously low premiums, fueling demand for more subprime mortgages. The subprime mess, an overview. Before we look at the key players and components that led to the subprime mortgage crisis, it's important to go back a little further and examine the events that led up to it. In early 2000, the economy was at risk of a deep recession after the dot-com bubble burst. Before the bubble burst, tech companies' valuations rose dramatically, as did investment in the industry. Junior companies and startups that didn't produce any revenue yet were getting money from venture capitalists, and hundreds of companies went public. This situation was compounded by the September 11th terrorist attacks in 2001. Central banks around the world tried to stimulate the economy as a response. They created capital liquidity through a reduction in interest rates. In turn, investors sought higher returns through riskier investments. Gotcha. Enter the subprime mortgage. Lenders took on greater risks, too, approving subprime mortgage loans to borrowers with poor credit, no assets, and at times no income. These mortgages were repacked by lenders into mortgage-backed securities and sold to investors who received regular income payments, just like coupon payments from bonds. But consumer demand drove the housing bubble to all-time highs in the summer of 2005, which ultimately collapsed the following summer. The subprime mortgage crisis didn't just hurt homeowners, it had a ripple effect on the global economy, leading to the Great Recession, which lasted between 2007 and 2009. This was the worst period of economic downturn since the Great Depression. After the housing bubble burst, many homeowners found themselves stuck with mortgage payments they just couldn't afford. Their only recourse was to default. This led to the breakdown of the mortgage-backed security market, which were blocks of securities backed by these mortgages sold to investors who were hungry for returns. Investors lost money, as did banks, with many teetering on the brink of bankruptcy. Homeowners who defaulted ended up in foreclosure, and the downturn spilled into other parts of the economy, a drop in employment, more decreases in economic growth, as well as consumer spending. The U.S. government approved a stimulus package to bolster the economy by bailing out the banking industry. But who was to blame? Let's take a look at key players. The biggest culprit, the lenders. Most of the blame is on the mortgage originators or the lenders. That's because they were responsible for creating these problems. After all, the lenders were the ones who advanced loans to people with poor credit and a high risk of default. Here's why that happened. When the central banks flooded the markets with capital liquidity, it not only lowered interest rates, it also broadly depressed risk premiums as investors looked for riskier opportunities to bolster their investment returns. At the same time, lenders found themselves with ample capital to lend and, like investors, an increased willingness to undertake additional risk to increase their own investment returns. Risk premiums at the investment return asset is expected to yield in excess of the risk-free rate of return. Okay. What the fuck? Oh my god. Oh, that's wild. I didn't know that. You can change tabs with page down and page up. And that's really handy for me because my page and page down are right next to my arrow keys, so. Wow. Does that work in Google as well? Oh my god, it works for Google as well. Jesus Christ. That's cool. I'm going to be doing that a lot. Why do my stuff look different now? I did something, I don't know what I did. Okay. But I get it. After all, the lenders were the ones who advanced loans to people with poor credit and a high risk of default. Here's why that happened. When the central banks flooded the market with capital liquidity, it not only lowered interest rates, it also broadly depressed risk premiums as investors looked for riskier opportunities to bolster their investment returns. At the same time, lenders found themselves with ample capital to lend and, like investors, an increased willingness to undertake additional risk to increase their own investment returns. In defense of the lenders, there was an increased demand for mortgages, and housing prices were increasing because interest rates dropped substantially. At the time, lenders probably saw subprime mortgages as less of a risk than they really were. Rates were low, the economy was healthy, and people were making their payments. Who could have foretold what actually happened? Partner in crime, the home buyers. We should also mention the home buyers who were far from innocent in their role in the subprime mortgage crisis. Many of them played an extremely risky game by buying a house they could barely afford. They were able to make these purchases with non-traditional mortgages such as 228 and interest-only mortgages. These products offered low introductory rates and minimal initial costs, such as no down payment. No down payment is insane. Their hopes lay in price appreciation, which would have allowed them to refinance at lower rates and take the equity out of the home for use in another spending. However, instead of continuing to appreciate, the housing bubble burst, taking prices on a downward spiral with it. When their mortgages reset, many homeowners were unable to refinance their mortgages to lower rates, as there was no equity being created with the fall of housing prices. They were therefore forced to reset their mortgages at higher rates they couldn't afford, and many of them defaulted. Foreclosures continued to increase through 2006 and 2007. In their exuberance to hook up more subprime borrowers, some lenders or mortgage brokers may have given the impression that there was no risk to these mortgages and the costs weren't that high. But at the end of the day, many borrowers simply took on mortgages that they couldn't afford. Had they not made such an aggressive purchase and assumed a less risky mortgage, the overall effects might have been manageable. Exacerbating the situation, lenders and investors who put their money into securities backed by these defaulting mortgages ended up suffering. Lenders lost money on defaulted mortgages as they were increasingly left with property worth less than the amount originally loaned. In many cases, the losses were large enough to result in bankruptcy. Investment banks worsened the situation. The increased use of the secondary mortgage market by lenders added to the number of subprime loan lenders. Subprime loans lenders could originate. Instead of holding the originated mortgages on their books, lenders were able to simply sell off the mortgages in the secondary market and collect the originating fees. This freed up more capital for even more lending, which increased liquidity even more, and the snowball began to build. A lot of the demand for these mortgages came from the creation of assets pooling mortgages together into securities such as collateralized debt obligation CDOs. In this process, investment banks would buy the mortgages from lenders and securitize them into bonds, which are sold to investors through CDOs. Rating agencies, possible conflicts of interest. A lot of criticism has been directed at the rating agencies and the underwriters of the CDOs and other mortgage-backed securities. They include subprime loans in their mortgage pools. Some argue the rating agencies should have foreseen the high default rates for subprime borrowers. They should have given these CDOs much lower ratings than AAA rating given to the higher quality tranches. If the ratings were more accurate, fewer investors would have bought into these securities, and the losses may not have been as bad. Moreover, some have pointed to the conflict of interest of rating agencies, which receive fees from a securities creator, and their ability to give an unbiased assessment of risk. The argument is rating agencies were enticed to give better ratings to continue receiving service fees, or they ran the risk of the underwriter going to a different agency. Gotcha. Regardless of the criticism surrounding the relationship between the underwriters and the rating agencies, the fact of the matter is they were simply bringing bonds to market based on the market demand. Right? So you're trying to bring sense and logic to cash flow. Or you're trying to bring objectivity to cash flow when subjectivity will inherently make you more money. You exist as an entity to make money. Right? Obviously, a rating agency is designed to apply some sort of rating parameter on these securities, but at the end of the day, you're doing so in order to collect these service fees, which is your bottom line. If your bottom line is, if I rate these securities lower, then most people aren't going to, other people are just going to undercut me then, because it's such a big wave, right? The CDOs, because I'm assuming that they started as a big wave of like, this is the new kid on the block for the market. And so what happens when you start rating them lower than AAA, right? Let's say you're rating them, I don't even know how they rate them. Let's say it's like a B. I don't know if that's real, but rating them at a B. What are the underwriters going to say? Like, are they going to just accept your rating or go to the other rating who's like, no, they're tripping. It's not a B. It's AAA. You're losing money from the new kid on the block. What are you supposed to do? Now it can be clearer now, right? We have the disaster. There's a Great Recession, so they can obviously rate it more accurately, but how can you have prevented something like that from happening like nowadays? If another thing, a new kid on the block again comes on where their rating is very questionable. It's an interesting paradigm. Fuel to the fire, investor behavior. Just as the homeowners are to blame for their purchases gone wrong, much of the blame must also be placed on those who invested in CDOs. Investors were the ones willing to purchase these CDOs at ridiculously low premiums instead of treasury bonds. Okay. These enticingly low rates are what ultimately led to such a huge demand for subprime loans. In the end, it's up to the individual investors to perform due diligence on their investments and make appropriate expectations. Investors failed in this by taking the AAA CDO ratings at face value. Don't forget the hedge funds. Another partly add to the mess was the hedge fund industry. It aggravated the problem not only by pushing rates lower, but also by fueling market volatility that caused investor losses. The failures of few investment managers are contributed to the problem. To illustrate, there is a hedge fund strategy best described as credit arbitrage. It involves purchasing subprime bonds on credit and hedging the positions with credit default swaps. Ooh, okay. CDSs. I gotta pay attention. Okay. Another party added to the mess was the hedge fund industry. It aggravated the problem not only by pushing rates lower, but also by fueling market volatility that caused investor losses. The failures of a few investment managers also contributed to the problem. To illustrate, there is a hedge fund strategy best described as credit arbitrage. It involves purchasing subprime bonds on credit and hedging the positions with credit default swaps. This amplified demands for CDOs. By using leverage, a fund could purchase many more CDOs and bonds than it could with existing capital alone, pushing subprime interest rates lower and further fueling the problem. Moreover, because leverage was involved, this set the stage for a spike in volatility, which is exactly what happened as soon as investors realized the true lesser quality of the subprime CDOs. Because hedge funds use a significant amount of leverage, losses were amplified and many hedge funds shut down operations as they ran out of money in the face of margin call. The bottom line, there may have been a mix of factors and participants that precipitated the subprime mess, but it was ultimately human behavior and greed that drove the demand, supply, and investor appetite for these types of loans. Hindsight is always 20/20, and it is now obvious there was a lack of wisdom on the part of many. However, there are countless examples of markets lacking wisdom. It seems to be a fact of life that investors will always extrapolate current conditions too far into the future. Okay. That's a good read. Let me get another water. Okay, 401k options. When it comes to investing via your 401k plan, you can make things as simple or complicated as you like. Some people spend hours researching investment strategies and asset allocators trying to maximize their gains. Others are content with the slow but steady growth offered by target date funds or broad-based index funds. No matter what strategy you choose, there will more than likely come a moment when you'll have to choose among seemingly similar funds. Let's look at how you can assess them and make comparisons. You should look for funds with low fees and a risk-reward profile that matches your preference. You can also make use of Morningstar's star ratings to help you decide among funds. However, be careful not to let it dominate your thinking. God damn, dude. Finally, take a look at past performance of a fund while keeping in mind that short-term performance is an unreliable guide to long-term returns. To begin, we're going to assume that you understand the basics of how investing in a 401k works and have some idea of what strategy you would like to follow. The succinct advice is to make sure that your portfolio is balanced, meaning that it contains a mixture of asset types. This is known as your asset allocation and is generally split among domestic stocks, international stocks, and domestic bonds. As you get closer to retirement age, the standard advice is to gradually reduce the risk in your portfolio by reducing your exposure to stocks. A target date fund will do that for you automatically. Okay. Oh, that's interesting. Or a portfolio split between the S&P and 500 index fund and U.S. Treasury bonds, you will have decisions to make. Intelligently structured 401k plans offer a huge range of funds for investments, so even if you are looking for a simple tracker fund, you may have 5 or more options available. At this point, there are 2 basic assessments that you can make. First, look at the fees associated with each fund that you are considering when choosing investments. For your 401k, avoid funds that charge high management fees and sales charges. avoid funds that charge high management fees and sales charges. Index funds generally have the lowest fees because they require little or no hands-on management. These funds are automatically invested in shares of the companies that make up a stock index, such as the S&P 500 or Russell 2000. And they change only when those indexes change. If you opt for well-run index funds, you usually look to pay no more than 0.25%. Second, consider the risk that each fund represents to the value of your portfolio. Funds, even those focused on the same asset class, can be put on a spectrum from low risk, low reward funds to high risk, high reward funds. If you decided to invest 30% of your portfolio in stocks, you can do this via high risk stocks funds with potentially higher returns, or low risk, low return funds. This consideration is a highly personal one and known as your risk tolerance. Once you are qualified to say that whether you like the idea of taking a flyer or prefer to play it safe. Even if you spot some great new investment options for your 401k, make sure that you keep your portfolio balanced. Diversification helps you capture returns from a mix of investments while protecting your balance against the risk of a downturn in any one asset class. True. There are also more sophisticated methods for assessing your 401k options. A number of companies and websites assess the funds available in a 401k and claim to be able to identify well-performing funds. The most well-known of these sites is Morningstar. You can look up a fund there and see detailed information on it. This will include its assets, historical performance, and even a star rating. This rating appears to offer a simple way for investors to choose funds, but don't be fooled. There are concerns that the ratings are misleading, and research has suggested that they are not always a reliable guide to performance. However, since then, Morningstar expanded its star rating system with 3 additional systems to measure funds and their performance, looking at both the forward-looking qualitative and quantitative as well as backward-looking quantitative. Even with the additional analysis, take care not to rely too heavily on any one source for investment guidance. The most complex assessment you can make is trying to predict the returns of a fund based on past performance. The bad news here is that this is almost impossible in the short term. However, if you look at the performance of a fund over at least in the past 5 to 10 years, and ideally longer, you may get a sense of the average returns that it has offered over that period. If all else equal, if 2 funds have the same fees and roughly the same exposure, go for the better performing fund. The least risky investment in a 401k would be either money market funds or U.S. Treasury bonds. However, these which will typically offer a very low rate of return and may not keep up with inflation. It won't even keep up with inflation, damn. The most common investment for 401k plans are mutual funds, though some are starting to offer exchange traded funds, both mutual funds. Basket of securities. A well-designed 401k plan should be to provide you with a wide array of investment possibilities. Regardless of which investment strategy you select, you'll probably have a myriad of similar funds from which to choose. Start with low fee funds that have a high risk reward profile with which you are comfortable. You can also make use of Morningstar star ratings to help you decide among funds, but you must not rely on them excessively as their track record is mixed. Finally, take a look at the past performance of a fund while keeping in mind that the short-term performance is an unreliable guide to long-term returns. Okay. I remember reading this and just not knowing what any of these words meant, but now I'm way better. Okay, I like what I got here. Next episode is going to be the highlight of the fucking streaming. It's going to be my Roth IRA, which means I will finally set up a Roth IRA. But that is all for me. Yeah, see you in the next episode, dudes.